Give a round of applause.
Thank you and good afternoon. I know it's getting late in the afternoon. A lot of people are outside networking. I hope you're still up to a few trends, facts and figures, numbers. But before we get into that, does anyone know this gentleman? Thomas? This guy is even too old for me. So that's Thomas Watson, CEO of IBM in the 30s, 40s and 50s of the last century, CEO of the Big Blue. He made one famous or infamous statement in the 40s saying, I think there's a world market for about 5 computers. Now, I'm sure even the young people among you know this guy. He also made a famous or infamous statement in the early 80s saying, I think 640K ought to be enough for everyone. Speaking of PC memories. Now, you people in the room and those out in the lobby networking are those that will make sure that current generations and future generations of experts will be equally wrong in their predictions about the future. In order to make your innovations work, in order to turn them into products and services that are marketable and that are profitable at the end of the day, you obviously need brains, you need passion, you need stamina, you need creativity, but unfortunately you also need money. You may, at the early stages, at the later stages, looking to partner with someone who can accelerate the development of your firm, the development of your products, entering into new markets. Someone said it actually today. We're now at the stage where we can think about doing acquisitions ourselves. And at some point, you may think about an exit and start a new venture. That is where firms like ours come in to help you with the funding, to help you with the partnering, to help you with the potential exit. Alantra was a startup. We were a startup ourselves 20 years ago. Nowadays, we're a global mid-market advisory firm, still with a primary focus on Europe, but we also do have 70 or 80 professionals in the US and an office in Shanghai and one in Hong Kong. In investment banking for us means providing advice in M&A and providing advice in financing, both debt and equity. We're around 400 professionals now, still mostly focused on Europe. Within tech, M&A, tech advisory, you have 60 professionals focusing on tech only. Those sit primarily in San Francisco, New York, London, and Paris. So when we do a tech deal, in Switzerland, we draw upon those resources. We're a globally integrated firm. The big advantage of that is we have global access to investors, we have global access to potential partners, we have global access to potential buyers should you think about an exit. So far, and what I should say, and I hope that doesn't shock you because I know a lot of you are early stage, the deals that we are doing or we are advising on typically range between 50 million and 1 billion in size. Now, when it comes to tech, deal sizes tend to be smaller, and we have recently teamed up with a firm called Avolta Partners based in Paris, and they are doing early stage advising on fundraisings. So now we believe, and that's important in tech and in fintech, we can accompany your venture from the very early stages to the potential exit. Here's a few so-called tombstones of deals we were involved in. I won't bore you with those. What I would say is they range from a few million in fundraising to the largest one actually being a Swiss deal or one with Swiss involvement. We advised 6 on their acquisition of BME, so the Swiss stock exchange acquiring the Spanish stock exchange, a 3 billion euro deal. And we're sort of proud to having been involved in the reshaping of the European financial infrastructure. Now, what you're really looking for, we at Alantra, we look at 6 subsectors when we speak of fintech. Banking tech, capital markets, credit and data, lending, payments, and wealth tech. Of course, insurtech and crypto finance should be part of that definition as well, but those are so big and would warrant a speech in themselves, so I left them out for today. So all of those are closer to banking, and that's what I want to focus on today. All of these, you see that on the right-hand side, represent huge market opportunities, and most of them have significant growth potential. The biggest one, according to those predictions, is payments. I mean, we have seen in the last 5 years, 10 years maybe, an abundance of deals in the payment sector, yet this is just the beginning. It's going to grow significantly. Predictions are for 300 billion of addressable market annually in the payment sector in 10 years from now. And interestingly, deal values are keeping pace as well. I mean, you see, and it's getting a bit blurry here because these deal values do not necessarily exactly differentiate between new fintech and old-fashioned players in this segment, but deal values add up to several hundred billion a year in those various subsectors. Now, someone said this morning he was involved in a fundraising round with a valuation of the ARR, an ARR multiple of above 100 times. Now, if you look at those classic multiples here, EBITDA multiples or revenue multiples, that's 21 data. What you see here in the later stage and more mature transactions, valuations are high, yes, but they're not completely unreasonable. They range between 15 and 25 in terms of EBITDA and between 5 and 10 in terms of revenue multiples. Of course, there's many other factors to look at, and of course, valuations are coming down right now. Now, is that a bad thing? Personally, I don't think so. It may be a healthy thing even. Of course, people may have to accept down rounds in their next financing, but what is truly important, if you have a solid business model, you will come through this unscarred and healthy, even if you have to accept the down round. It all comes down to solid business models, and to some extent, then it will separate the healthy from the unhealthy. So personally, I'm not too worried. It's painful, but I'm not too worried about the downward trend in valuations. Now, a few trends that we think, none of those are new, but that we think that will gain pace in fintech in the next few years. One is the trend to non-banks and non-financial institutions embed solutions for their clients, financial solutions. You know, the Facebooks, the Googles of this world are getting into this market. The latest example is Apple entering the buy now, pay later market in the US for now, but I'm sure that will come to Europe too. For the incumbents, the banks, that's an opportunity and a threat at the same time. I mean, it's an opportunity insofar as they can offer their products and services to the non-banks, to the non-financial institutions. On the other hand, I think the big battle is, and the end game here is, who owns the client? Who owns the account? My personal belief is, I dare to make a prediction here, my personal belief is, in the long run, the advantage is with the non-banks. The hurdle they have to overcome is regulation and differing rules and differing approaches to regulations in various countries. Another trend that we have seen big time during the pandemic is millennials flowing into neobanks and consumer-first trading wealth platforms. I guess you all remember the GameStop hype last year, where through blogs and an app, a trading app, a penny stock was hyped to crazy valuation levels. Now that's not a healthy development. And here regulators have stepped in as well as SROs. I think the sector is well advised to make sure that these things are not repeating themselves. And speaking about regulators, they have, and someone said it this afternoon, they have primarily focused on crypto finance. And it is, between innovators and regulators, it is a catch-up game. You guys, the innovators, are always 1 step, 2 step, 3 steps ahead of the regulators, but they're catching up. And the difficulty for you is, especially within Europe, I believe that regulators in Germany and in Switzerland, for example, are taking different approaches to the same questions. And that makes the internationalization of your business models not impossible, but more challenging, more time-consuming. One thing which is great about fintech is global financial inclusion. You make the world, or can make the world, a better place. The buzzword here is maybe microfinance, maybe digital payment solutions for everyone. I mean, we all, in our part of the world, we all speak of overbanking. There's large parts of the population in this world that have no access to banking, no access to payment solutions, no access to credit solutions, no access to capital markets. That is where you can step in and help. Finally, open banking is a reality, certainly so in the US, where 75% of bank account holders use open banking. In Europe, it's a bit slower, again, primarily due to differing approaches of the regulators, but it's for sure open banking cannot be stopped, will gain in importance. Another challenge for the incumbents here. Let's take a quick look at a few numbers. Left-hand side M&A, right-hand side funding rounds. What you see here is M&A is almost purely driven by classic private M&A transactions. IPOs, very few and in between, and SPACs are a non-factor. Personally, I believe that may actually change now with the downwards trend in valuation. There is good opportunities for SPACs to get invested and to de-SPAC, but still classic M&A will prevail and most of the exits will happen on that route. With regards to fundraising, you see reflected that the biggest part is actually happening in the sector growing the most, that's the payment sector. That's attracting the biggest chunk of the pools of money. I'll spare you with the details of the few subsectors, but I'll point to the FinTech report that is much more detailed than this that we have just published. You can download it from this presentation or at our booth over there. Now, the title of my presentation was Start with the end in mind. Now, obviously, the end, meaning a potential exit of your venture, is just a new beginning, not an end. But what you need to keep in mind early on, and I said it before, be clear on your business model. A few simple rules. Are you B2B? Are you B2C? Are you B2B2C? Are you C2C? Are you all of it? All of it at once? What's your revenue model? What's your distribution model? It's worth spending enough time on defining and then executing on the business model. Business model leads to business plan. Define a few important milestones within your business model in terms of time. You know, building of personnel, building of revenues. When do we achieve cash flow break even? What financing means do we have? How do we approach that? And by doing so, be sure of one thing. It always takes longer. There may be 1 in 100 exceptions to that rule, but it always takes longer. Plan for it to take longer. Of course, most of your businesses are about growth, some of them about steep growth. Before that growth actually results in positive cash flows, it may take years and it needs financing. Now, with regards to growth financing, don't just look for money, look for smart money. There's lots of smart money sitting in this room. These people can help you. They have gone through bringing startup firms into a more mature stage many times. It's not just about valuation. It's not just about retaining a high stake. It's about partnering with the right firms. Focus on company value. With that, I do not just mean, obviously, you need to focus on what are our key value drivers in developing our business. Of course, you need to focus on valuation. But what I mean is, over time, and that's a mistake a lot of founders commit, try to make the business independent of the founders. Solid product base, large market coverage are better in resulting in peak valuation when you think about an exit than dependence on 2 or 3 brilliant brains. As silly as it sounds, try to make your business independent of yourselves. Flawless housekeeping, now that's the boring part, but it's important. It starts with, and someone said it this morning, try to protect what you can't protect. Think about IP. What can you protect, what can you not protect, and how do you do it? Keep track of the corporate setup. Keep track of the financing rounds, and so on. Flawless housekeeping is key to a potential exit. If you don't have that, you won't exit. And then, from the very early beginning, speak to potential strategic partners. Speak to the strategic players in your sectors. Those may be your clients. Identify those where your product, your solution closes a value gap, or simply a gap in what they do. That may help you to better understand the needs of these strategic players, but it may also help you to sharpen your equity story and to sort of better target potential buyers when it comes to thinking about the exit. Now again, we've just issued a very comprehensive 60-page fintech report. Please download it with a lot of global trends and data. Now that's me. If you find out, with the benefit of hindsight, that my trends and the few predictions I made proved to be completely wrong, remember, I'm in good company. Thank you. 4 seconds ahead of time.
Thank you so much, Mr. Rüegg. Absolutely wonderful. Thank you.